Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. Canada's annual inflation rate has reached its target 2%. Largely pushed by lower gasoline prices, it's the lowest level since February 2021. To explain how he is finding opportunities as Canada's economic picture shuffles, is Fidelity's long-short alternative fund manager, David Way. David explains to the audience and host Pamela Ritchie how the fund is navigating the transition from a higher interest rate environment to a lower one, and how he is positioning the portfolio to take advantage of the sectors that stand to benefit. He also highlights the potential of AI and how the fund is looking for companies that can effectively deploy this technology to drive business growth rather than just cost savings. On the short side, David explains that it's often easier to identify companies that may struggle with technological disruption, such as those with functions that can be automated with AI. David also discusses the impact of consumer behavior, noting that value-conscious consumers are gravitating towards businesses that can offer compelling value propositions. This podcast was recorded on September 17th, 2024.
Hi, David Way. Great to see you.
Pamela, how are you?
I'm well. Great to see you and have you here in studio. And we'll invite everyone to send their questions in over the next little while. Okay, well, let's go with the headline. We've got inflation at 2%. Does this massively change the way you look at your portfolio, or has it been changing it?
I think the whole path to getting here has been a big change in the market and obviously reflected in the fund. And we've gone through a period coming, you go all the way back to COVID, right? We had all this unprecedented monetary and fiscal stimulus. It was very likely that we would see a high inflation environment. The timing was what was uncertain. We saw that. The market digested that through 2022 and 2023. And as inflation has started to come down, it's sort of become a clearer path towards lower rates. And so I try not to predict individual interest rate cuts or the very specific path of rates, but
you're not alone in that. Everyone says that.
It's a fool's errand. But as an equity investor, the direction and to some degree magnitude are really important in identifying, the correct playbook to use of when to engage with certain stocks that really start to benefit from a lower rate environment for consumers and for companies.
Yeah, for sure. So ultimately, are you using that to then look at sectors specifically? I mean, there are sectors that just sit with the playbook of lower interest rates are here.
Yeah, so I think the playbook tells you where to look.
Yeah.
And the strength of Fidelity is calling companies, doing research, and figuring out of the areas you're looking at, what are the ones that provide the greatest opportunity. And so as we migrated from this higher rate to stable to lower rates, one of the areas where the fund built exposure was in certain consumer sectors, like take for example home builders, where there is very strong fundamentals, particularly in the U.S. around household formation, demand for housing, and an interesting wrinkle where with existing home sales, a lot of people refinance their mortgages during the very low interest rate period. So any seller of an existing home has to walk away from like a 2-3% mortgage and take on a 6% mortgage at their next home. And so if you are a home builder, operating from a clean slate, you're in a much stronger position to sell your house. So even though overall housing demand fell, home builders actually gained market share through this period and were able to kind of keep their businesses moving, which is a lot different from 15 years ago when we had the big US home building bust. Like the industry is very different and well positioned to gain from lower interest rates.
Are you finding more opportunities to take the U.S. home builders as a sort of entree to that? But generally speaking, are you finding more opportunities in the United States? Your universe is North America, right?
Yeah. Universe is North America. There's the U.S. market's so much bigger and so much deeper.
Yeah.
And especially in the area of large cap technology where AI is really changing the world, I think, for a lot of people. And also in the mid cap space, like a $20 billion market cap company in the US, like it might get ignored. Here it's like in the TSX 60. And so in terms of trying to help our research make a difference and really unearthing these companies that are not very well followed or misunderstood, like it's really great to be able to call them up and say, hey, we're from Fidelity, we want to ask you some questions. And They're very responsive. We get great access, and it helps us, find things before the market's talking about it.
Right. They probably don't like it if they think that you're going to short it, though.
Yeah, the good news is people.
They don't know what you're going to do.
People don't know. And I'll be honest. So, like, as a long short manager within a predominantly long-focused business, there have been companies that know I'm a short seller, know I short the stock, and it's had it hasn't impacted our ability to have a good relationship with those companies. As I try to explain to them, as a short seller, I'm a potential buyer of your company. And I have a lot more invested on the long side than I do on the short side. So I'm a friendly participant.
And you'll move back and forth, I'm sure, between the positions as they present themselves. So what is presenting itself? Give us a sense. Maybe you can't tell us exactly what you're doing today, but give us a sense of what kind of new opportunities. Let's start with the long side, and then we'll go to the short.
Yeah, I think that's a great question. And again, to set the table, the Fidelity Long Short Alternative Fund is really designed with two portfolios, a long portfolio and a short portfolio. So I'm trying to be long opportunity and short risk effectively. And so on the long side, the opportunity set is opening up again. So you have things like secular drivers around, artificial intelligence, companies taking this emerging technology. They're really just kind of experimenting with it, maybe pointing it towards cost reduction initiatives. But I think the really exciting part is still yet to come about which companies can deploy this to actually grow their business versus making it cheaper to run.
Do you have a view, do you have some visibility on that?
Yeah, I know the 5 winners over the next 5 years. No. The reality is...
We're trying to sit a 1-hour interview.
Yeah, exactly. The reality is it's still very early. And so what we're looking for, and when we talk to the companies, a lot of them don't want to, really promote the idea that they know the answer. And a lot of them don't. They're trying a lot of different things. And what good companies do is they run experiments to see, would this work? Could this help? And so you're seeing some early applications, and you can look at a Canadian company like Thomson Reuters, which is trying to deploy AI into its legal software, seemingly with positive results. Microsoft with Copilot. But really what I'm interested in are the parts of the market that they're not looking at. You can look at industrials, even in, older industries like commodities. It's very interesting. There are some companies and sub-industries where they're trying to deploy AI to, better mine for higher grade commodities. And there have been some suggested early positive results where, taking what the industry thinks they know, putting it through an AI model, and it's leading to more efficient exploration and development. So
it's just almost like Internet of Things stuff being sort of added with the AI story. It's everything from heat mapping to being able to find things faster.
Yeah, it's a slow build. And I think what you're really looking for in this is you're looking for a good company in a good industry where when they do actually innovate, it's an innovation that they're going to be able to hold on to and have as a competitive moat. Because I do think a lot of these applications, even on the cost saving side, I think eventually they'll get mostly competed away. When they invented the Excel spreadsheet, it made a financial analyst's job easier. But if all your competitors can use the same technology, it will get competed away in many areas. So I think the interesting piece, and one of the lenses I always try to apply is, where are the companies that will actually get to hold on to this?
Yeah, where are they? This is commodities we're still talking about?
No, in general, in terms of AI,
Yeah.
Technological innovation. It needs to be something that you can own in terms of...
So law seems to be one that gets pointed to a lot.
Yeah.
Lots of paperwork that can be sort of cut off, which is great. Where else in terms of companies?
Yeah. One lens you
Industries.
One lens you can look at are what are companies with very large data sets, where that data is proprietary, or their ability to merge that data, with other data is a proprietary offering. So, I was talking with the credit bureaus at a conference a couple of weeks ago, and some of the innovative things that they're trying to do to make credit decisioning and risk taking more effective for their customers. There are companies like Bloomberg or FactSet, companies within my industry that are trying to figure out how they can apply AI in a way that makes producing information helping people like me digest it and assist in my decision making. And so we're seeing little product introductions. And in a few cases, they're actually adding incrementally to their revenue base when they launch those features.
So on the so they are, it's becoming accretive in certain areas. So on the short side of the portfolio, is there anything in there that you're looking, for instance, companies that are not doing that? Or is that not there yet?
I think in any big innovation wave, like if you read a lot of history, in big innovation waves, it's often easier to see who will lose than who will win.
Right.
I think you can see in the stock prices that the market is largely betting that sort of call center customer support functions, where AI is clearly already making a big difference. The market's betting against their longer term survival or their ability to thrive. You can look at other companies that perhaps have libraries of images or other types of intellectual property that can easily be recreated by AI. The market has found those out. And so as a short seller, that was kind of an opportunity, I think, 18 months ago to really take advantage of. And if you look at the stock prices of many of these affected companies, they've gone from having success priced into, closer to failure.
Right. I mean, there's been some massive changes in valuations over the course of the last just few months even. Let's go into what we saw in August, how the fund ultimately deals and probably smooths the ride, but also finds opportunities in a state of true vol. I mean, August was a very volatile month, and actually recently has been too.
Yeah.
How does the fund work?
I think if you start with the building blocks of the long and the short portfolio, what I'm really trying to achieve is, very attractive returns. Like I think low returns with low risk as an equity solution is kind of not what I'm about.
Right. Okay. Other funds do that.
Other funds do that, and many of them, generate, the return profile that investors are looking for them. But I always think it's important to say, like, this is not a market neutral fund. This is a fund that has equity exposure because I believe long term that equity markets are a great place to invest. We can even look at, like now, as we were talking before, as we're going through this period where the Fed's cutting rates, there's been concerns around recession. But there's just so many parts of the market where like things are getting better.
Right.
It's actually like a really good time to be excited. And so I'm excited. That being said, I really enjoy having a long short fund because I can reach into that opportunity. And because I short stocks, I can actually own more of those best ideas we're excited about using the proceeds from my short sales and manage the risk of being wrong by shorting stocks that would really mitigate the risk of some of the long positions I've taken. So that's why you've seen more consistent results.
What do we imagine you doing in an August crazy vol spike?
Yeah.
Is that actually where, are you buying there? You're probably not.
So certainly there were a number of stocks through August that sold off where I was pretty optimistic about kind of what 2025 looks like. And if you like a stock at 100 and you're just like looking for a sort of more of a clearing event, and then it goes to 80, like that's a great thing.
Right.
Because then you can buy the stock 20% cheaper. And if you were playing for 20% upside before, you're now playing for 40. There's a lot of stocks that I had done work on, but kind of didn't get across the finish line. And the vol that we saw in August provided the opportunity to get involved.
And you weren't on holiday that week, so you could take advantage of it.
I always like to say at Fidelity, you can work from anywhere as long as you work from everywhere. So.
That's right. So tell us a little bit about what has been overbought. And, and August, I think, cleared a lot of stuff that probably was overbought. But it's been bid back up again. So I'm just kind of curious, like, you don't need to tell us exactly what you're going on with right now, but there are pockets of things that have been overbought. It looks like valuations were high.
Yeah, I think so. And it's always challenging. And when you're a short seller, what you're really looking for is you're looking for expensive valuation and things starting to go wrong.
Right.
And so there have been a number of stocks, like if we look within consumer, if you take the area of like fast casual, you can think about like Chipotle and competitors where there's a lot of optimism about the ability of these chains to grow, valuations very high. And And what you're really looking for is some deterioration or crack in the amazing fundamentals that have driven these valuations.
And the consumer themselves?
And the consumer themselves, I think, respond to value.
Okay.
And so to the extent you see these chains starting to take, too much price, showing a negative impact on traffic, these are the sorts of signals where, you might see investors start to have a bit of a confidence crisis about the very long-term growth trajectory of these businesses. And because they're so expensive, like any small change in their growth prospects can have a really big impact on their share prices. And so that's an area where I've been looking for opportunity because if there's any kind of questioning of the long-term prospect of these businesses, there's meaningful downside. And that's really what I'm looking for when I'm shorting, is I'm looking for, a very small loss if I'm wrong, in return for the promise of a larger return if I'm right.
So give us a little bit of a sense, we just dig in there a little bit deeper of, so consumers, as you're saying, are more value conscious than they were. We've experienced very high price rises over the last little while. What are you finding consumers are gravitating towards? Like, I'm just wondering if sort of middle restaurant is not what they're gravitating towards, for instance.
Yeah, it's very interesting. I was at a conference listening to a number of industry experts as well as franchisees and restaurant owners of the larger public companies. And there's a very clear picture that's currently emerging. The headlines that people may have seen would be McDonald's value offering and the $5 value meals, really trying to bring back consumers' perception of value for quick service restaurants. Like you think Burger King, Wendy's, McDonald's. The consumers kind of lost that trust because we saw these price increases through COVID. And it appears from looking at social media that these offers are really getting people's attention. And so within restaurants, if you're delivering really great value, customers are responding. If you're just kind of ho-hum, then they're either choosing a better value offering, they're eating at home, or they're going to a Chipotle type restaurant where it's not a formal casual dining seated experience, but the food's good, feels like a treat, really strong value. And so the sort of the middle is really getting squeezed, and you're seeing pretty significant value
dispersions
offers.
There.
Okay. So we don't have a lot of Chili's in Canada, but if you go to Chili's right now, you can get a $10.99 value meal where you get a burger, fries, chips and dip, and a drink for $11. And it's driving positive traffic there. So if you sell stuff cheap enough, people will go there, but the consumer is very finely attuned to value. And even on the good side, you can look at Walmart, which continues to outperform its peers, the dollar stores, et cetera, doing a very simple thing. Their prices are lower.
Right. And you can get everything there. So would you say that the margin story is quite different in the next, say, 6 to 12 months than it has been in the last 6 to 12 months?
Yeah, I think there's a couple things in there that I think are really important. The first one is, freight costs, which were very high during COVID, have come down. And really, the companies are benefiting from that this year. We're also seeing inflation going from high levels to lower levels, which is generally supportive of company margins. The caveat to that is that you really need to look for companies that are growing enough to offset the underlying inflation that they're seeing. And I think it was 10 years ago, I met with the CEO of an apparel company, and they were growing 5-6%. And there was some concerns about their growth. And they said, they were the CFO of this company, and they said, as long as we're growing faster than 3%, we can just cover the natural inflation that we see. And that was in a low inflation world.
Right.
So companies that are growing faster than 3% have the opportunity for some of that to flow into margins. And I think if you're growing more slowly than that, it's still in a lower inflation environment, it's still an uphill battle for inflation.
Right. That's really interesting. I was going to ask you. So, inflation is there, but if you're growing faster than it, you're going to be okay. Are you looking at changes within companies that they're making on the margin story, either to, more productive in a lot of different ways, through cuts, through lowering prices by getting more foot traffic? Tell us just a bit more about that. How are they accomplishing that?
I think the easiest lens that I apply to these types of companies, and it applies to consumer and industrial companies, is when you sell something to your customer, are you delivering a compelling value proposition? And the way you can evaluate that is, think about consumers. So Chipotle for $14, you get a bowl full of real food that tastes really good. There's a lot of consumer surplus in that. You're like, I would pay more for this. And there's a lot of things where you're buying it feeling like, they're really kind of taking every last penny off of me for the value that I get from this product. So in the consumer landscape, you're looking for people who deliver value. And so within Canada, I think, Dollarama offers a very compelling value proposition to its consumers. And they do it in a way that allows them to generate, a lot of profitability, which is great. And even though customers of industrial companies aren't consumers, they're still thinking about that same value proposition. So, zoom right into like industrial machinery and farm and tractor equipment. John Deere raised prices a lot through COVID, and they couldn't supply enough for the level of demand. And now we're in a world where corn prices are lower, farmer profitability is being hurt, and a lot of people who've been lifelong John Deere customers are saying, this piece of equipment's like 40% more expensive than it was 3 years ago. Like, I might consider a different color paint, where there's a competitor offering maybe a more basic product, but at a significant discount. And the farmers are saying, well, I can live without these bells and whistles and the green paint if it means I save 40% on my purchase.
So that's really interesting, just to sort of look at that and what you find in there potentially to, I don't know if those companies that you're talking about are overvalued particularly, but it's a change in sort of the consumer reaction to them. And so when does that filter through to the stock price? Are you finding that filters through to the stock price at this point?
Yeah, so at Fidelity, we're always interested in doing very deep research. So, when I make these statements of like, these are the observations, like the company's not telling you this. They're telling you like things are fine. We're like gonna, manage our production, but we're talking to, farmers, we're talking to people who sell to farmers, and we're really trying to build this mosaic of like, what makes sense at the micro, like what's consistent across regions, across people, because if you get 100 people in the room, you have 100 opinions, but you're looking for those like common threads. And then when you can tie a very strong common thread across comments and see a disconnect between a company's share price and the underlying fundamentals, what's true is that the valuations of these companies have contracted. People have said that they're going from a high growth period to a lower growth period. Earnings revisions have been pretty negative for these businesses. But there's still a gap. If things go back to like pre-COVID levels, 2019, 2018, in terms of margins, it's very likely that there's more negative earnings revisions to come. And then that's where the difficult work of saying, is this priced in or not, comes. And it's probably a more detailed discussion than we have time for.
Okay, well let's go to this question. A couple of questions rolling in. So one of them is, how has your long-short conviction changed since the fund's inception, which is going back almost 4 years?
It's 4 years in October, and obviously piloted it for almost 2 years before that. So
fascinating times through the markets.
We've sort of seen it all, and I think the how has the long-short conviction changed? I think I have more confidence in my process than I did 4 years ago. Like I remember at the launch and in the early days of the fund coming out saying, I hope to generate, attractive returns with lower volatility. And now I'm here sort of saying I hope to continue generating attractive returns with lower volatility. And so I have more confidence in the process. That being said, as a PM at Fidelity, you tend to be your own toughest critic. And I'm constantly looking at mistakes I've made, things that I could have done to improve the fund's performance, either on better returns or lower risk, and trying to continually implement improvements and change to the process. And I think on the long side, there have been points in time where, the macro outlook has seemed, pretty negative. But when I looked at the micro, the company specific setup was better than, what the clouds in the sky were telling us. And, for me, one of the lessons is to have more conviction in that bottom-up analysis and the microeconomics of what's going on. Pay less attention to all the noise around us and just kind of ask yourself, where's change happening? And can I really wrap my arms around this opportunity, whether it's a long or a short, and invest behind it? Like all of my better decisions, they should have been bigger decisions in the fund. And so conviction, I think, needs to grow over time as your process works, because you need to lean into what's working. And then, simply from a trading and sort of other technical aspects of running the fund, there's a lot that I've learned over the last 4 years. And I think, every year you should get a little bit better at your job.
What would you say is the thing that you've learned the most this has been quite a year thus far.
Yeah.
There's so many changes that have happened even this year. What have you learned about this year?
I think with this year, it's, I've always sold my winners too early. And this year, what I really tried to do is to, adapt to changing information, be a little bit more flexible on valuation, and at some point, really try to not make a decision to just sell a stock, but to manage the position size down as my conviction waned. But I'm really more focused than I used to be on paying attention to what is changing incrementally and not just trying to enforce my view of what a stock's worth onto the market, because the market is relentless. It's smart.
It's bigger than us.
And it's bigger than us. And so I'm not just saying go with the flow and ignore valuation, but just work a little bit harder to be more flexible. And I think that's something that's really helped the fund this year.
Oh, it's really interesting. Well, we look forward to sort of seeing how it goes throughout the rest of this year. Here's a question. I was asking you about this earlier. So have any companies moved from a long position to a short position within the portfolio or vice versa?
Yeah, I have been, I've gone from long to short to long on a number of companies. The usual barrier to that happening more often is if I'm short a stock, I generally see something structurally wrong with the company. And let's say that thesis plays out and the stock gets cheaper and the market becomes more aware. My first step is to cover the stock. And in general, what needs to change is maybe something like a change in management or a change in market outlook to take that sort of structural problem away. And that just doesn't happen that often. There are companies that I've owned on the long side that I think are really good companies. Maybe the market just got too optimistic. Maybe the market was just their end markets were just too good. And usually when a good company meets a tough industry, it's the industry who retains its reputation, famous Warren Buffett quote.
Right.
And I see that a lot sometimes. And honest companies, they're really trying to do the right thing, but just the industry headwinds become so big. So it's more often that I'll go from long to short than short to long.
Okay, really interesting.
Because I tend not to short a lot of companies like that because, over time, an honest management team is working really hard to improve their business prospects. And in many cases, if they've done it successfully in the past, the market will look ahead and past those tougher industry patches.
As a final question, I didn't want to give you a throwaway question at the end. Do you think we're able to look through some of the economic headwinds that many will say are happening in this country? Is the market going to look through many of those, or are we going to feel that more acutely in Canada? And maybe you'll go through it.
It's a huge question. I think some of the challenges that Canada faces are structural in terms of our long-term productivity decline, overinvestment in housing, while at the same time having inadequate housing. Increased taxation, disincentives for business formation. Some of those will take a much longer period of time to really work itself out. And that's why it's great to have geographic flexibility. I can kind of go where the opportunity is. But, it won't get in the way of kind of the industry champions, whether we have some oligopolies that might be bad for consumers. They're actually good for the companies and they can earn more stable and higher returns over time. So those continue to be relatively unaffected. But what the market's the most willing to see through are things like, high interest rates have dampened, underlying strong consumer demand for a product or service. And as rates fall, that demand comes back. People will look through it if they really believe that lower rates lead to higher demand. And that's kind of the art of being an investor. You need to invest and put that capital to work before everybody else gets comfortable. Because if you're comfortable, then everybody knows it and the stock's up and you missed it.
I think you're becoming a statesman and it's really exciting to see. David Way, thank you very, very much. I think we all learned a ton from your conversation. Wishing you well in the markets.
Thank you. Thanks for having me.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on Twitter. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.